Stifel strategist Barry Bannister has said that he's sticking with his call that the S&P 500 closes this year at 2,800, which implies about a 6% upside. But from there, he believes things get ugly. For one thing, 2019 is likely to bring a bear market, and then, for the decade after that, the market likely will trade sideways, the victim of overvaluation and a retreat from the Fed-fueled bull run that began back in 2009. He further expects an abysmal outlook for the S&P 500 return from 2018 until 2027. He also explained that the Fed and its counterparts goosed the market with trillions in money printing, most of which was used to buy government bonds and inject liquidity into the market. However, policies are beginning to diverge, with the Fed ending its quantitative easing program and embarking on interest rate hikes. Central banks front-loaded equity prices, he said. The payback is now, a long, flat decade ahead. Stifel has been telling his clients to move to more defensive market names as market stasis sets in. And they've also stated that losers will be passive investors who will see returns fall away as the major indexes don't gain any ground, while the winners will be active managers who pick stocks for a living. So then, let's pick your poison. Like many colorful English language phrases, pick your poison started in a tavern somewhere. Poison was slang for liquor. So a barkeep would ask a new patron, "What's your poison, mister?" It's also a very useful paradigm for thinking through U.S. equity sector allocations. Investors have shifted their thinking from where's the best upside to which sector's poison is the least likely to kill my portfolio. At first blush, this may seem like a simple observation, but it has a few useful offshoots. First, the sector with the weakest poison will tend to outperform in a down market. You just have to pick the sectors whose stories will seem the least bad to other investors. And second, by explicitly considering just the downside case for a group, we can assess what amount of bad news might prove lethal. So today, we're going to do a sector check. Let's get started. And the first sector up is the technology sector. And the technology sector has two main poisons. The first poison is the regulatory risk. And the problem here is that supercap tech stocks have the lightest ratio of regulation to market capitalization of any other sector in the market today. So even a small amount of regulation will seem dramatic. And then the next poison is the higher interest rate levels and the high valuation. With rising interest rates, they're bad news for richly valued tech companies, and higher rates may be on their way. Looking at the chart here, this is a 5-year weekly chart, and I'm using the 5-year weekly chart because Stifel has argued a bear market, not a crash, a bear market, and then a slump for the next 10 years, or low returns for the next 10 years. And I think the 5-year weekly chart will serve us for this analysis. And looking at the chart here, the technology sector has taken its bumps like any other sector here in the last few weeks or so. We find ourselves just moving down below the 20 EMA, this blue line or purple line here, and reaching toward the 50 EMA. I don't think we're going to get down that far. But let's move on down here to the MACD. We see that the MACD is still in a free fall somewhat, moving from above the trigger line through the trigger line and down. We see that here also in the MACD histogram, with the histogram reaching at levels that we haven't seen in the last 5 years or so. However, the momentum indicator does not look as bad. The price rate of change looks reasonable. The relative strength here is at a moderate 47.65, just barely under the 50 or midline. The stochastic as well, moving down here, this is above the 50 or midline. Moving into the volume, that looks fine with an uptrend here recently. And the Williams looks relatively fair as well. And back up here to the price chart. Looks like, again, we've gone through that 20 EMA, and that has not happened since, say, mid-2016. So perhaps this is an area for consideration. Let's go to the next sector. And this is the energy sector. And this sector has one poison, basically commodity prices. And the energy sector is one of the worst performing groups year to date. And that tells us equity investors don't trust the recent rally in oil prices. And I really want to like this group because the poison seems to be innocuous. And energy has a long history of decoupling from commodity fundamentals only to rejoin them suddenly. So there's a lot of up and down movement. And this sector, though, has had the best earning comps for Q1 of any industry group. And that makes this group an even weight, or perhaps a better weight if one has the stomach to own this market laggard. And as we can see here, it has not done well for, say, since mid-2014, and it's down. Moving here into the MACD, it looks like the MACD is heading just below zero, but looks like it wants to try to set a base here. Moving here into the histogram, we see much the same there. Momentum indicator is still heading down, and it looks like it's not ready to turn yet. Moving into the price rate of change, looks like the price rate of change is having a little bit of trouble in turning. We're going to need another month or two. Into the relative strength index, we're at a moderate 47.83, but it looks like we have some upward movement there, a little bit of green light. Into the stochastics, looks like the stochastics wants to turn, giving it an attempt there. It may take a little while, such as it did back here. A little bit of sawtoothing before it finally, the fast line moves through the slow line. We'll wait and see. Volume looks moderate, but no problem there. And then the Williams looks like it wants to try to bottom here. So all in all, the energy sector is a possibility. So keep things in mind with regard to current oil prices, but monitor this and see where some of those oscillators start turning, and this might be a sector for your consideration. Now let's go to the last sector. And this last sector we're going to take a look at is utilities. And you might want to include in this sector real estate investment trusts, because oftentimes utilities and REITs move the same way, simply because the poison for utilities and REITs is higher interest. And all of these groups have underperformed this year as long-term interest rates have been rising, and they're threatening to rise even further. And it's hard to like these groups simply because of the possibility of higher interest rates coming. However, prudence says that an even weight position in this sector might be a good idea, just in case the crowd is very wrong on interest rates. And I'll have more to say about interest rates in upcoming videos. But as we can see here, I actually like this pattern. We can see that the stock does come up to a high, it retreats and then bases for a while and then moves on up. It bases for a while and moves on up. Now this one here moved down, it based, and then it moved to a higher high. Moved down, and the base was relatively short, and then it moved to another higher high. So we've now had the downward move, and looks like we're going to base here for a while. So keep your eye on that. Now, I'm going to stop here at this sector, but you can continue to do further analysis. It's relatively easy, and I'll show you. Moving on down here using realtimestockquote.com, you can go into the chart settings and use this pull down window, and you pull that down and you can get all the different sectors. Beginning here, you have the Dow, the S&P, the NASDAQ, the Russell. Then you move into the sectors, starting with the consumer discretionary sector, into the staples, consumer staples sector, energy, financial, healthcare, industrial materials, technology and rounding out with the utility sector. So it's easy enough. And this task, you should do this task probably every couple of 3 months just so that you can keep your eye and see where money is flowing. Because money likes to flow to the easiest way to make an earnings. So check this out and compare and contrast these different sectors to follow where that money is flowing, where it is rotating to. But for now, that's ChewDog Charts. Thank you.